All four major precious metals had another solid week of price action. Gold finishes the week around $1,515 per ounce. The spot platinum price cleared $950 an ounce. And palladium strikes another record high, mostly due to an increasing shortage of the precious metal, closing this week around $1,850 per ounce. The silver spot price closes this week at $18.18 per troy ounce in fiat Federal Reserve notes. Speaking of the Federal Reserve, they cut another 25 basis points this week to the federal funds rate. They are also now often extending over $100 billion in Federal Reserve note repo loans through the New York Fed desk every night. Apparently, the Federal Reserve wants us to believe that in the years prior to the 2008 financial crisis crescendo and subsequent $29 trillion in collective bailouts, that beginning in 2007, that was just normal balance sheet expansions and repo loans leading into the 2008 financial crisis. But the problem is that in the 6 years before 2008, the Fed added $200 billion collectively to their balance sheet. They've now done that and $50 billion more in just the last month and 10 days. This week's returning guest is Dr. Peter Warburton, who called in from London to mainly discuss the devolving situation with corporate credits. Hear not only how perceptive his debt and delusion writings were at the turn of the millennia, almost 20 years ago, but also we dig into high detail on what may be the next major phase of financial deterioration, what may be the source, and how totally unprepared the world is for potential high inflation that may follow. All that and more, right after this brief message from our show's sponsor. Want to get away? SD Bullion is giving away a free VIP trip for two to the Royal Canadian Mint. Winners will receive free round-trip airfare to Ottawa, Canada, 2 nights hotel accommodations, and a private VIP plane tour of the world-class RCM facility. Founded in 1908, the Royal Canadian Mint makes some of the world's most popular and the widest array of precious metal bullion bars and coins. See and learn firsthand how gold and silver coins and bullion bars are minted. To join this sweepstake, legal U.S. residents age 21 and older, visit sdbullion.com/sweepstakes for your chance to win. This contest ends November 20th, 2019. No purchases necessary. See official rules for details. Good luck. Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of sdbullion.com. With us this week is a returning guest. He's Dr. Peter Warburton, Director of Economic Perspectives. Doctor, thanks for coming back on the show.
That's a pleasure.
So, Doctor, back in the year 2000, my guess is you were writing in the late 1990s, you wrote a prescient book published. It was called Debt and Delusion. And in it, there had been a couple articles that had been released on the internet around that time. You were making some arguments about major things that were going on in terms of the escalation in debt, even in the year 2000. Obviously, now we stand at a global record debt level, but even back then, you could see the writing on the wall for what it was. I wanted to take a brief pause here because there were 3 paragraphs of this article entitled "The Debasement of World Currency. It is Inflation, but not as we know it." And I wanted to read them so listeners could understand how prescient you were. You wrote, "What we see at present is a battle between the central banks and the collapse of the financial system fought on 2 fronts. On one front, the central banks preside over the creation of additional liquidity for the financial system in order to hold back the tide of debt defaults that would otherwise occur. On the other, they incite investment banks and other willing parties to bet against a rise in the prices of gold, oil, base metals, soft commodities, or anything else that might be deemed an indicator of inherent value. Their objective is to deprive the independent observer of any reliable benchmark against which to measure the eroding value, not only of the US dollar, but of all fiat currencies. Equally, their actions seek to deny the investor the opportunity to hedge against the fragility of the financial system by switching into a freely traded market for non-financial assets. It is important to recognize that the central banks have found the battle on the second front much easier to fight than the first. Last November, I estimated the size of the gross stock of global debt instruments at $90 trillion for mid-2000. How much capital would it take to control the combined gold, oil, and commodity markets? Probably no more than $200 billion, using derivatives. Moreover, it is not necessary for the central banks to fight the battle themselves. Although central banks' gold sales and gold leasing have certainly contributed to the cause, most of the world's large investment banks have overtraded their capital so flagrantly that if the central banks were to lose the fight on the first front, then their stock would be worthless. Because their fate is intertwined with that of the central banks, investment banks are willing participants in the battle against rising gold, oil, and commodity prices. Central banks, and particularly the U.S. Federal Reserve, are deploying their heavy artillery in a battle against a systematic collapse. This has been their primary concern for at least 7 years. Their immediate objectives are to prevent the private sector bond market from closing its doors to new or refinancing borrowers and to forestall a technical break in the Dow Jones Industrial. Keeping the bond markets open is absolutely vital at a time when corporate profitability is on the ropes. Keeping the equity index on an even keel is essential to protect the wealth of household sectors and to maintain the expectation of future gains. For as long as the objectives can be achieved, the value of the US dollar can also be stabilized in relation to other currencies, despite the extraordinary imbalances in external trade. So, Doctor, I know it was a little bit long-winded, but those 3 paragraphs, when I read them, were extremely prescient, and they still seem prescient today. I want to get your thoughts on maybe 20 years later, how you feel about those 3 stanzas.
Well, thanks. Yes, it's interesting. Sometimes you write something and it kind of sticks around for a while. But yeah, I mean, I guess back then, I was a skeptic of central banks and their mission, and I remain a skeptic. I know, many of the key characters who have served in these positions. Well, certainly, in the UK and one or two abroad as well. And it's not that I'm personally hostile to them. I just think that the mission of the central bank has been widened so much that it is truly impossible to fulfill. And I mean, I think you can regard this as partly an abdication of executive authority by the political process to these unelected agencies, so regulators as well as central banks. And the problem with an unelected agents, committee running an agency is that they will try their hardest, to stick to their brief. In most cases, they are very diligent. They're not reckless of their nature. But my point really is that central banks should never have accepted this wide-ranging role that they've now found themselves with, and indeed over the last 20 years that role has expanded. So clearly we from that standpoint, we had the Argentinian debt default in 2001 that seems like it's kind of coming around again. But we were heading into a very dangerous time. It looked as though that we were heading into the sort of a down phase of a credit cycle. This is back in 2001. And actually one of the things that I do take as a kickoff point in this latest presentation were the speeches that were made in the fall of 2002 by Alan Greenspan and Ben Bernanke, because I think they were quite influential in I think undergirding the corporate credit system. So basically, if you like, equity investors have had these progressive 50% declines. There's the decline of the dot-com boom in 1999-2000, and then they lost another 50% again, obviously from a higher starting place in 2007, 2008. So the regular investor, the retail investor, has been very attracted to corporate debt as a kind of halfway house between equities and government debt, and which typically has yielded less. And so, before I move into to the actual thesis of the piece that I sent to you, and happy to share with with listeners of Silver Dollar is that this is no longer a safe place to be. So central banks, if you like, have helped to make corporate credit a safe place to be for investors. But actually, it's increasingly vulnerable and deceptive to be a significant investor in corporate bonds. Mm-hmm. Now, what happened in 2002? There were two speeches that I thought were particularly significant. One was from Alan Greenspan, where he talked about the expanding risk universe, and I'll just quote back to you a particular phrase that he said back in September 2002. It was, if risk is properly dispersed, shocks to the overall economic system will be better absorbed and less likely to create cascading failures that could threaten financial stability. So Alan Greenspan, as you remember, is a great fan of derivatives. He always thought that if we could just kind of build out the derivative system, we could insure all the risk, there'd be deep pockets in the system, and no one would ever need to go, bust. There'd always be someone over their shoulder, ready to sort of take on the risk and pick up the pieces. Mm-hmm. And basically the show could just carry on. Need to have downturns, wouldn't need to have recessions, wouldn't need to have bankruptcies, wouldn't need to have debt defaults. This wonderful, sort of picture of an expanding universe that would just keep on going. Mm-hmm. So he kind of painted a picture of, don't worry, the risks are not as great as they appear. We have insurance in place. And then Ben Bernanke sort of followed up with what is now the classic anti-deflation toolkit speech, which where he talks, really about all the things that a central bank could do, even when interest rates reached the lower bound of well, we thought it was zero then, but obviously we've since come to realize it's about minus 50 basis points. But right. But however, a central bank, he said, retains a considerable power to expand aggregate demand, even when its accustomed policy rate is at zero. Now, so the effect of these speeches, which I think not everyone appreciates, was to put a floor under corporate credit, and not just investment grade corporate credit, but pretty much all corporate credit. So over the next 18 months, corporate credit spreads collapsed. Corporate credit was a fantastic place to be because essentially we had these influential voices saying there isn't going to be a recession. Mm-hmm. But what I noticed really was that from about 2013, if you like, the favorable circumstances that Greenspan and Bernanke created have started to erode. And so really all through the Yellen years and now into the Powell years, we're getting back, we're edging back into that same scenario that we were in 1999, 2000, of, if you like, the weaker credits having to pay more. In fact, I just saw a chart today showing that the triple C rated debt looks like it's going to have its worst year in terms of return since 2008. So you say, well, why is that? Where's the recession? Where is the trouble that is comparable, to 2008 that could be creating this kind of a negative return? And I think the issue for me here is that a lot of what central banks do is illusory. They're if you like, magicians to some degree, and it's as though the cloak that the central bank, in this case the Federal Reserve, has thrown over corporate credit, it's like it's kind of no longer able to cover the whole market. It's like it's kind of only now able to protect maybe the investment grade universe, and maybe not even all of that. Obviously many will be aware that the triple B has become a kind of euphemism for a lot of companies whose balance sheets certainly wouldn't justify a triple B rating, but there's some sort of soft variables that go into their rating that top them up to make them appear still looking like investment grade credits. Mm-hmm. So what I'm talking about is a splitting or bifurcation of this of the credit markets, where, if you like, the lower part is then pricing according to default risk and illiquidity risk, and obviously illiquidity in junk bonds is rife. A friend of mine in Florida, who I rely on for some of this color, it tells me that there's only something like a quarter of the junk bond universe that trades on a regular basis. So that a lot of these junk bond funds, have very little daily liquidity, very little basis on which to sell things, in which to satisfy redemptions should they be required. Mm-hmm. So what we're saying in here is that there is a financial fragility problem once more, mm-hmm. In the U.S. corporate system, but also more generally, because this is an international market. Clearly, there's arbitrage. Sure. A lot of international reach for yield has come to the U.S., and so to some extent it is a focal point. But clearly, in emerging debt, then there's loads of echoes. And in sovereign debt in Europe, there have been echoes, although again at the moment the central bank guarantee is given a lot of credibility. We've just to digress, we've just had an instance where Italian and Spanish sort of 3-year debt trades on negative yields, and we actually had 3-month Greek debt trading on negative yields. I mean, which is obviously a very extraordinary and perverse situation. It's one which markets freely arranged with price discovery and independent actors would never give you these outcomes. So if we want proof that what we have is a highly distorted and interfered with market, we have plenty of evidence.
Sure. So you've in the thesis that you sent over, which I'll put in the show notes so people can read it, you cite that this is the coming collapse of corporate credit, and there are 3 tranches, if you will, that you kind of covered. One was high yield bonds and bond funds, the other leveraged loans, and then the third was triple B tranches of corporate bond markets. Now, if triple B, correct me if I'm incorrect, but if something goes from triple B to something lower, they can't be held in pension funds, I believe, legally, right? Isn't that a huge reason why maybe there's so much crowding right now in the triple B tranche? And if they start getting moved to junk status, they can't be held in pension funds. Is that correct?
Absolutely, and not only pension funds. I think a number of other long-term investors, and indeed, just regular funds with with specific rules and mandates would be obliged Sure. to step out. I mean, I think there are a few issues around this. Another one is that were you to get an actual downgrade, or the prelude to a downgrade, a bond being put on negative watch, mm-hmm. Then some of the big companies that are sitting in this triple B portion, I mean, they would potentially add, in some cases up to 10% to the universe of junk bonds.
Wow.
So in other words, they would be they would make a massive splash in the pool. So in other words, even if you didn't have the issue of people unable to hold them, you've then got the problem of you need more new investors, as it were, to hold junk bonds, because the universe has just got a whole lot bigger. Mm-hmm. I don't really want to talk names. There obviously there's a few obvious kind of names that people have been concerned about in the telecom and the auto sectors, and maybe in retail sectors in particular. But it's just to say that because of the low interest rates and the kind of central bank insurance of the system, there are now some absolutely massive borrowers. I think the largest is $250 billion of debt on the balance sheet, but there's a few others that have over $100 billion of debt on the balance sheet. So, in an environment where corporate profitability is weakening and corporate cash flow generation is weakening, then it's to see how problems could arise. And so the issue I brought attention to is what if something which has been pricing close to the government curve according to its maturity, what if something switches from that pricing mechanism to pricing its illiquidity or its industry characteristics or its default risk? I mean that could be a big a big event in terms of the year, and of course that investors, knowing that they own even for big companies sort of debt instruments that are not very liquid, are you going to wait for the next earnings figures that say that things are not going too well? Are you going to wait for the next regulator to pronounce on a part of their industry and their business, or if you think there's any risk that you might get trapped in a cascading bond price scenario, then you have every incentive to move early. And I think what we should be watching for are these kind of waterfalls of bond prices, where things are still nominally triple B, but effectively they're being priced as if they've been downgraded. Mm-hmm. So I think that's kind of what we're talking about there. Now, I mean, the other two contexts. Leveraged loans. A lot of spotlights have been thrown on leveraged loans. I think again, it's a CLOs are a non-mark to market instrument, so there's a lot of illiquidity, but if you like, they're mostly grown-up players here. They're mostly the kind of investors who understand that these are not liquid and readily saleable assets. And you could say, well, it's well dispersed internationally. There's there's German insurance companies in there. There's Japanese banks in there. There's a variety of private equity funds invested in leveraged loans and CLOs. So you could say, well, this is a grown-up market, and yeah, if something goes wrong, then those losses are going to be spread around. So we're talking about the whole leveraged loan market are north of $2 trillion, about sort of 70% of which is US based. So yeah, if there was an event in that context, it would be pretty significant. I mean, I guess what we don't know is what the indirect exposures of the banks. So, for example, the banks might be financing private equity to a significant extent, and therefore the pain could still come back into the banking system, but just through a different route. Right. So you could say that leveraged loans, okay, they are dangerous. They're all sort of the middle of the rating of leveraged loans is around a single B, which obviously is a weak credit. But yeah, obviously the whole point is here that you're getting rewarded for these risks. It could be mispriced. But I guess the junk bonds is the primary concern. It's where what we can see is that historic patterns of relationship between economic indicators and default rates have been broken. In other words, that the fall in the US ISM, the non-manufacturing PMI, in the past has been reliably associated with much bigger, much faster pace of defaults than we currently see. so then we're back to, again, the sort of financial repression and the whole expansion of the moral hazard vista that has separated leverage from some sense of danger. Mm-hmm. So, in brief, what we're saying here is that we think that once again credit risk is mispriced. But importantly, what I'm saying is that I don't think that central banks can fix the problem. I think that central banks, they will continue to repress interest rates, and that repression will still be a benefit to the strongest companies and the highest ratings. But I don't see how it will protect everybody. Yeah. And so I think the challenge here now is to see how much trouble we get and how quickly, and obviously in terms of what people regard as safe, I think will have to be considerably reevaluated. I mean, so obviously it plays into the attractions of gold and silver and platinum and other either precious metals or
finite commodities
in scarce supply. Mm-hmm. I mean, it's quite an interesting correlation. I'm sure that you've seen it in various places. How the gold price sort of tracked the rise in the stock of negative yielding debt. Whether that means that we have to get to $30 trillion of negative yielding debt to get a decent extension to the gold bull market, I'm not sure. But no, certainly I think when we see price distortions of this scale, then I think it's an important reminder. We need to be looking in other places for stores of value.
Now, you wrote 20 years ago, the central banks, their objective is to deprive the independent observer of any reliable benchmark against which to measure the eroding value of their fiat currencies. I mean, essentially in the last 20 years, when you just listed, a lot of the various precious metals and finite commodities have gone up precipitously in value, but not exponentially. There was a time in 2011 where people were really afraid when U.S. debt got downgraded, et cetera, and we had new nominal highs in gold and over 1900. But I mean, I think we're talking about looking out in this coming decade and even beyond, perhaps, where fiat currencies go to the wall against finite goods and things that are, going to show off the fact that these fiat currencies have inflated much further than we've actually admitted to one another, and that the majority of the world is under a delusion in believing that these things have so much value as they do even currently. I think in the next 10 years we may see that exponential rise, maybe that perhaps you may feel is coming, or I don't know. I'm not sure. Maybe there'll be a switch. Maybe we'll have a structural reset. I'm not sure. If you put on your speculative cap, what do you think's coming in the next decade or two, Doctor?
Well, I think the most important change that we're likely to see, so this really reaches back to some other work that we did earlier in the year. But taking a long view mm-hmm. of the policy framework. So a lot of people that I meet, investors in particular, are very comfortable with the view that inflation is not a problem. Inflation is low, will remain low, will probably become even lower. And obviously all of that sort of cultivates a sense that fixed income securities are the best place, to have your money. Mm-hmm. Now, the problem I have with that is that we know that at significant points of history, I mean, obviously the 1930s contained one, Bretton Woods breakdown in 1971 would be another, that there are some significant points of history where continuity doesn't hold.
Right.
That you step out of continuity into discontinuity, and if you like, you have plenty of warning that trouble was coming, and it's a reminder really that if you like, what we regard as money, does actually shift in time, and what we currently regard, if you like, as the basis, the societal basis of agreement about what is valuable. I think that's under immense pressure right now. So, I mean, nailing this down a bit more, I suppose you would say, well, it's looking very much like, fiscal conservatism is dead. It's looking like the balanced budget commitment is dead. Obviously, places like Germany have enshrined it in law, and I guess that might be one of the last places that you might think would break apart. Mm-hmm. But I think in many other countries, America and the UK included, then we are not far away. I think from a complete rewriting of that monetary settlement, and obviously one way that could happen is is kind of massive fiscal spending that is financed much more obviously by money than by debt. Right. But there are many different routes into this, and many different mechanisms. But they essentially take us to the same place, which is that the settlement we have isn't working for enough people. Right. That if you like, what we've done is we've sort of we've crystallized economic advantage and disadvantage out of the financial crisis. And essentially what the way that things are organized is we've largely just had compounding, so if you've got very little to compound, then you've got, very little compounded, and vice versa. So in a sense, the politics we have now is reflective of the dissatisfaction with the economic settlement. So I think this is a very dangerous time. I mean, it took from on my reading of the situation, it took from 1963 through Lyndon Johnson, Great Society, Vietnam War. It took all of that, before we got to 1971 and a new monetary settlement. Right. Now, I'm thinking that that you should think about the financial crisis of 2007-8 as starting the clock, mm-hmm. really on a new monetary settlement. So I know it kind of seems like a long time now, and we kind of, some people think that that things are settling down and that we're in a much better place. Right. I would warn that we're not really. I think what we've done largely is the absolute minimum to keep the show on the road, and I think that fundamental challenge is heading our way quite soon. So I'm saying here is I don't think that we'll stay in this low inflation world, even as measured, before we get into those issues. Right. I think there's going to be a burst of inflation, a price reset in the Western world, and most people I think are completely unprepared for that to happen. I mean, my father retired from work in 1974, just as a massive inflation was taking place in the UK. Right. That in 2 years the value of his pension was halved by the rise in inflation. And I'm not saying that what we're going to see is necessarily as big and significant as that. But I just wanted to put out there that this kind of risk, this kind of cataclysmic event risk, generational, multi-generational change, is not priced in financial markets. Right. You basically what what we're seeing priced in inflation swaps and break-even and so on is essentially more of the same. But the question you've got to ask is, who is, in the political spectrum, who is the guardian of keeping things the same? Increasingly what we have now are people competing with really quite revolutionary ideas about how things should be changed.
Sure.
And so I think it's completely inconsistent with this idea that somehow that central banks will be able, even if they were, sort of, if their hands were untied, to meet an inflation objective. I don't think that's going to be the number one priority of policy in the way that it has been in the last 25, 30 years. And so, I think the answer to the question is you need to be thinking much more broadly about what will preserve value, in this next few years.
Well, Dr. Peter Warburton, we really do appreciate you coming on our show, and thank you for taking the time. How can viewers find you? Where can they get your information in the coming years?
Well, there's our blogs and some other information is there on our website, which is economicperspectives.co.uk. Obviously, there's you can send us an email if you've got particular interest. Obviously, we, as a firm, we're set up mostly to to speak to institutional investors. Sure. But sure, we know I'm happy to debate on particular issues. So yeah, please get in touch, or if your readers come across kind of like pieces of evidence that think help to build the argument, then we're always very, very pleased to receive those.
Well, great. Thank you so much for taking the time today, Doctor.
Not at all.